Welcome back to Gate Gain, where we turn everyday financial systems into optimized tools for personal wealth growth. In today's full visual breakdown, we are exploring Fintech app arbitrage, a completely legitimate strategy focused on organizing high-yield savings accounts, automated cashback stacks, and banking deposit promotions. Navigating this ecosystem safely requires understanding exact operational terms, risk management, and federal insurance protections. By the end of this session, you will know how to construct a streamlined financial stack that maximizes every single dollar without crossing into unsafe territories. Before jumping into complex mechanics, we must define what financial tech arbitrage actually represents in consumer banking. In traditional markets, arbitrage refers to taking advantage of price differences across different platforms to lock in low-risk value. In the modern banking realm, platforms compete aggressively for consumer liquidity by offering sign-up incentives, elevated annual percentage yields, and rewards programs. By systematically aligning your daily funds across these regulated digital platforms, you can optimize interest returns and collect promotional rewards seamlessly, while keeping your initial capital fully secure. Safety always comes first when dealing with digital financial applications. So, checking federal coverage is your absolute primary step. You must verify that any application handling your money holds insurance through the FDIC, or the National Credit Union Administration. Many digital tools operate as financial technology companies rather than chartered banks, meaning they partner with partner banks to sweep your funds into insured accounts. Always review the fine print inside the application to ensure your balance is held directly at a partner institution, covered up to $250,000 per depositor. High-yield savings accounts form the steady base of any modern yield management stack. Standard legacy checking accounts often return nominal yields that fail to keep pace with inflation over long periods. Online financial institutions reduce overhead costs by operating without physical brick-and-mortar locations, allowing them to pass those savings back to account holders through significantly higher interest rates. Utilizing these digital accounts allows your emergency fund and liquid cash to generate meaningful passive growth while maintaining total access whenever expenses arise. Understanding the fundamental math behind compound interest helps clarify why moving cash into modern financial accounts creates such a major difference over time. Annual percentage yield accounts for the actual frequency at which interest compounds, whether that compounding occurs daily, monthly, or quarterly. Daily compounding moves earned interest straight back into your principal balance every 24 hours, accelerating your growth curve faster than simple annual calculations. Selecting financial applications that feature daily interest compounding ensures your deposited money is constantly compounding at maximum efficiency without requiring extra manual transfers. Beyond baseline interest, direct deposit bonuses offered by digital institutions represent substantial short-term returns on liquid capital. Modern platforms continuously launch initial deposit promotions to encourage new users to transition their primary paychecks over to their platforms. These promotions typically require a specific dollar amount to land in the account via automated clearinghouse transfers within a fixed time window, such as 60 or 90 days. Meeting these initial parameters unlocks a cash reward that acts as an immediate percentage return on your incoming earnings. To consistently qualify for modern deposit promotions, you must clearly distinguish between authentic direct deposits and standard external bank transfers. Financial systems classify incoming electronic funds using automated clearing house coding, where employer payroll or government benefits carry specific corporate transaction tags. Standard peer-to-peer transfers or simple bank transfers between your personal accounts often do not trigger promotional qualification engines. Checking tracking threads and institutional disclosures guarantees that your payroll settings are properly mapped to meet promotional requirements smoothly on the first attempt. Keeping a meticulous tracking calendar is essential to avoid accidental maintenance fees or missed promotional eligibility windows. Most institutional promotional rewards mandate holding funds inside the target account for a set period, ranging from 30 days up to 6 months. Prematurely withdrawing funds or closing an account prior to the agreed timeline can trigger early account closure fees or clawbacks of the original promotional payout. Maintaining a central record of account opening dates, required balance thresholds, and minimum maintenance durations keeps your operational stack completely safe and compliant. Automated cashback stacks build upon your savings foundation by extracting passive value from routine, everyday consumer spending. Instead of relying on a single card or app, a stacked structure layer rewards programs on top of each other during a single transaction. For example, initiating a purchase through a digital cashback portal using a specialized rewards card while claiming store loyalty points triples your return. Automating these multi-layered rewards through browser extensions and financial apps allows you to capture cashback without altering your spending habits. Debit card roundup programs provide another seamless layer of automated micro-savings by turning loose change into structured deposits. Whenever you complete a daily transaction, the application automatically rounds the total purchase up to the nearest dollar and routes the difference. Aggregating hundreds of monthly purchases creates a continuous, frictionless stream of capital flowing into interest-bearing accounts. Many digital platforms even match a percentage of these microdeposits, adding free bonus equity directly to your principal. Strategic cash routing serves as the central nervous system that connects your checking, high-yield savings, and automated rewards tools seamlessly. Establishing recurring transfers allows your incoming paycheck to distribute automatically into dedicated financial buckets the moment it arrives. Essential bill funds remain in your primary account, while immediate emergency reserves and savings move straight into higher-yield vehicles. Maintaining clear liquidity buckets prevents you from over-leveraging capital across multiple promotional offers at the same time. Always keep a primary liquid reserve inside a zero-fee account that allows instant transfers for immediate daily living expenses and unforeseen emergencies. Evaluating potential tax implications is critical. Interest generated from high-yield accounts is categorized as taxable income by regulatory authorities. Financial institutions issue specific documentation, such as Form 1099 int, at the end of every tax year for rewards exceeding standard thresholds. Confirming that a digital application performs soft credit checks allows you to open accounts without harming your credit standing. Systematic record keeping through secure personal spreadsheets or dedicated tracking dashboards keeps your entire financial stack organized and clear. Monitoring minimum balance rules is vital. Dropping below that balance can trigger a monthly service fee that eats into your earnings. Utilizing dedicated secondary communication channels helps streamline your promotional tracking and protects your primary personal inbox. Cybersecurity practices form the ultimate defensive layer. Assign unique, complex passwords using an encrypted password management platform. Enabling multi-factor authentication, preferably using dedicated authenticator applications, adds strong defense against unauthorized account access. Reviewing app notification settings allows you to maintain real-time oversight across your entire connected financial network. Managing overdraft protection correctly prevents unexpected fees from disrupting your automated savings strategy. Understanding institutional relationship rules helps you navigate welcome rewards and long-term customer benefits effectively. Evaluating early account closure clauses protects your earned rewards from being reversed or penalized by the issuing institution. Optimizing automated clearinghouse transfer networks ensures fast and free movement of capital between your various financial applications. Combining high-yield savings, money market accounts, and certificates of deposit allows you to lock in elevated yields while keeping cash liquid. Managing mobile check deposits correctly provides another safe method for moving capital. Always write for mobile deposit only clearly on the back. Recognizing the difference between simple marketing rate boosts and sustainable baseline yields prevents unnecessary platform hopping. Continuous financial literacy and staying informed on changing institutional promotion terms ensures long-term success with digital financial tools. Strategic organization turns complex financial app structures into a seamless, automated passive income stream. Thanks for watching, subscribe to this channel, and like the video if you found it helpful. Leave your questions in the comments below.